Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by BetaShares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, BetaShares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with BetaShares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. James, how you going, mate?
Very well, Owen. Yourself?
Pretty good. It's your first time on the podcast.
Yes, yeah, great to finally be here. I think we've been speaking about it for a while, so it's a good experience to get into.
Yeah, mate. Do you listen to podcasts?
A lot, yeah.
Yeah?
Probably too many, if you ask my wife.
What's your favourite show?
I really like the Australian Investors Podcast, which is a little bit biased, but it piques the interest, and I think the discussion teeters on the edge of being understandable, but also technical.
Yeah. Oh, well, thank you. For those of you that don't know, James is sitting right in front of me when he says this, so it would make sense that he says it here. But I do appreciate that, mate. And for what it's worth, we do have a lot of financial advisors that listen to the Australian Investors Podcast, or the Australian Retirement Podcast for that matter, because I think as industry professionals, we kind of like hearing what other financial professionals are thinking and doing as well, even if there is quite a bit of banter in between it all. Today, we're going to be answering some community questions, but given that this is your first time on the show and you're a financial advisor at Rask, I wanted to ask you a series of questions too. And so if you do have your question and you're watching this or you're listening to this, please send it in. There's a link in your podcast player. If you're on YouTube, you can just head into the description, or if you just love a good URL, head to rask.com.au/question, and just there it is. Mate, first of all, so I said that you're a financial advisor. How did you get into being a financial advisor / financial planner?
Yeah, so I've spent most of my working life in retail, starting off just at the bottom of the ladder, working at Woolies and eventually working into management, which was rewarding in some aspects, but it was a relatively tough job most of the time. And certainly after a couple of years, I realised it definitely wasn't what I wanted to be doing forever. So started studying. I didn't have any long-term trajectory coming out of school when I was younger. I didn't know what I wanted to do. But eventually, after going through a few units of a business degree and then coinciding with some life events and a bit of a passion for personal finance and understanding, how to get ahead, or, what would be the next logical steps for myself, financial planning popped up. So triggered the degree to that. And then, a few years later, eventually transitioned from retail management into financial advice.
A lot of people in our community think about this because they like, similar to you, they like personal finances, they like their own, they think they can help other people, which is great. But there's often a significant pay cut when you change professions or you go back to study. How did you think about that? Maybe take it from whatever angle you want, but I'm just thinking in terms of either lifestyle or how you budgeted for a career change. I'd be really interested in just knowing your general thoughts on that.
I think for myself, at least, the transition was quite gradual. So my wife and I, we knew that event was going to be coming up. So there was a period of time leading up to that where we were, building up the savings. When you're doing a career transition, you don't know what your new salary is going to be. It's an unknown. I applied for quite a few jobs and there was varying ranges of what was offered for someone into a brand new industry. But for myself as a mature age, I kind of valued my own ability and eventually came upon a salary that I was happy with, but it was still a significant drop. But yeah, I think it's just the key. You know that it's coming up, so you just need to plan for that ahead of time.
So what people don't know is that you also worked multiple jobs while you studied. And I know that chatting to you personally, that it wasn't just like one day you're here, next day you're there, as you said, it's gradual, but it was also a grind. And you've got a young family now and these types of things. So it's not always as simple as people first kind of think it might be. So having that kind of emergency fund, having that backstop of cash is so important for that transition. So you listen to podcasts. Do you read any books or do any of that sort of stuff as well, or is it?
Audiobooks, I find
Do
myself.
they count? Yeah, they count.
Yeah,
Okay,
I don't know. You're still hearing a story broken
Yep.
down over a longer frame than what a podcast is.
Yep.
But I find myself with limited time to actually sit down and read a book, and when I do, the eyes get pretty tired.
Yeah, I can imagine those sleepless nights, or sleep deprived as a parent with
Yes.
young kids. So that's totally understandable, mate. So we've got some questions here sent in from the community. Then I'll have a couple more for you at the end. And these are going to kind of go in a few different directions. We've got one that's about a recent collapse of kind of this investment firm, if you will. And then we've got another question about property or shares and ETFs, like what comes first? Do I invest or do I save, and all these types of things. I might also get you to riff a little bit on the First Home Super Saver scheme, which is a really popular scheme for people that are buying their first home. Before I get into the questions, just a standard disclaimer applies, obviously, to every episode here on the Australian Finance Podcast, which is that this is strictly limited to general financial advice only. It's not personalised financial advice. If you want personalised financial advice that takes into account your needs, goals, or objectives, that's where you need to speak to a financial planner. And they'll go through a bunch of different steps, like James here would want to get to know you and do a few other things before giving you personalized advice. And of course, if you do ask a question, I'd love it if you bring in a silly name or just something that's a bit of fun for the rest of the audience that listens. We do get a lot of questions. I was just showing James our spreadsheet that contains all the questions that we receive is well over 3,000 now in the last 18 months or so. And we've got the community where you can head to for 24/7 access to everyone else in the community. It's free. It's at community.rask.com.au. Mate, the first question comes from Miss Gullible. And this is actually a really good question. It was brought up in our community. And the reaction to it was kind of like, I don't know if you saw this, but the reaction to it in the community was kind of like, how could you trust a financial planner? Which I think was the wrong reaction to this. But there was a question that says, from Miss Gullible, with the recent collapse of First Guardian Capital and loss of superannuation for many individuals, what advice would you give to an individual and or an amateur investor on steps they could have taken to protect themselves from these kind of risks in the future? So I might generalize this for you and just ask you kind of, if you're speaking to a newer investor or just someone that's really mindful of this stuff, what are the things that you would be looking for as a financial planner before using one of these platforms, technologies, tools, or even just investing in something?
So first step would be the PDS, right? For any super fund or any product that you're investing in, there's a product disclosure statement. And they're pretty dry documents, but they actually outline everything about the fund that you need to know. And they're pretty important to understanding what you would be investing in. I guess the other consideration would be with this one, not really familiar with exactly what's happened, but I briefly read an ABC News article earlier, and it seemed to be the promise of higher returns. And I think if something seems too good to be true, then you do have to raise some pretty serious alarm bells and start questioning where things are going to go.
Do you have a preference between, like, one question we get a lot on the show, James, is the difference between like HIN-based brokers or custodial models? Do you see any difference really in that?
For most circumstances, no. I think there's a lot of larger, very transparent HIN and custodial models out there that can then both get you good outcomes.
Yeah, that's a good point. So just for people that want me to read verbatim from the ASIC website, so ASIC is the Australian government's financial services regulator, and they were called in, or they raised suspicions when they came across a few things for the First Guardian Master Fund, which was a managed investment scheme, otherwise known as a fund. Falcon Capital Limited was the responsible entity of the scheme and is now in liquidation. ASIC goes on to say, ASIC understands that investments were made into First Guardian by around 6,000 investors who access First Guardian primarily through superannuation platforms, the trustees for which were Diversa, Netwealth, and Equity Trustees. So big household names in finance. ASIC's investigation to date suggests that many of those investors were called by lead generators and referred to personal financial advice providers who advised them to roll their super assets into a retail choice super fund and then invest in First Guardian. So the idea here is that what made this probably so, I guess, sinister in a way is that people were relying on the advice of not only their financial advisor, but they were relying on the brand of the platforms in which they were investing in this thing. So the platforms themselves haven't gone down or anything like that. It's actually the thing that people invested in on the other end. And that's where it can be hard for an individual to really check those things. Most of us will be familiar with stocks going down. Sometimes, in very rare circumstances, stocks go out of business and they go to zero, but it's very rare. So people will be familiar with that experience. But investing in something when there's a professional supposedly in the middle, that's where it was probably people were caught out a bit. I think a few things is no matter if you get financial advice or you do it yourself, you've always got to ask the question and know what you're invested in. Because at the end of the day, it's your money. A financial advisor, and James, you can correct me if I'm wrong here, at the end of their statement of advice, aka financial plan, at the very back of the document that you receive, it has to show you all of the different investments. It also, investments generally, it will also show you the PDS to each of those. So that product disclosure statement that James mentioned. So you can go through and read exactly what your money is being invested in and potentially why is in the statement of advice. Another thing that I would say, James, is making sure that folks always check the ASIC website, the Financial Advisor Register. We call it FAR for short, Financial Advisor Register. You can put in someone's name or you can put in their number of their financial services license to determine if they're a legitimate provider. In this circumstance, it seems pretty harsh because there was someone that people seem to have trusted, James, and that's probably what makes it worse, I would say.
Yeah, and look, it's the same with any industry. There's bad players, unfortunately, and I think financial advice has taken a pretty heavy hit, especially over the last, say, 15 years or so. We had the Royal Commission through the middle of that, but there's been various other cases during that period of time where you've seen licensed financial advisors not doing the right thing. And I guess maybe just going back to that point, if someone's promising something that seems too good to be true, you do really need to question it. I guess unfortunately, it's just a nature of human life that there's always going to be people doing the wrong thing. But hopefully, ASIC always, does its best to clean up the industry and really penalises the people who don't do the right thing.
Yeah, and in this instance, it was ASIC. We should give some kudos to ASIC because ASIC did take it straight, I believe it was straight to the federal court to basically put a stop to this. And they've got this amazing Q&A and all these different updates, a running page on their website around the financial advisors and all those types of things who were involved in this. So it's actually a really interesting use case. I'm sure it will be in textbooks in a few years, unfortunately. But for the most part, if you follow those broad principles, know what you're investing in, make sure you check the financial advisor. If there's anything that's too good to be true, it probably is. So I was talking to you off air before about rules of thumb that people could use. If you look at, say, the stock market's return, doesn't matter which stock market, just say like the average of the good ones, like Australia, US, Europe, UK, even Japan, which has been pretty flat for a while. If you took the average, and let's say for round figures, it's 10% returns over the long term. If anyone is promising you anything more than that, I would start to get alarm bells, like massive alarm bells, anything more than 10% per annum. And that's just my broad rule of thumb, because I think, stocks are kind of the riskier side, the better performing things over the long term, if not the best. So for someone to promise me more than that, that seems quite risky. So as a rule of thumb for anyone just trying to protect themselves, go and check that out. Just keep that in mind. And before you go and check out the returns and all those types of things that other brands have. Then the next question actually comes from Rascally Rabbits, and this is the Rascally Rabbits. And they say, James, my partner and I are in our early 20s and wanting to invest for a future house deposit. Should we invest in a one-bedroom apartment for roughly $450K in 3 years after saving a deposit, or begin dollar cost averaging into ETFs now? The plan, I think what they're saying is the plan to buy the house rather than the apartment, which might be a stepping stone. The plan to buy the house is in 5, 7, 10 years. So it's still quite a few years away. They're just not sure if they need to invest in ETFs now, or if they maybe could consider buying a smaller, like an apartment first. This is a common question a common problem that many people get, James. Now, we're going to keep this general. We don't know who this person is. But when we think about that kind of stage of life, with either in your financial planning experience, your own experience, how do you think about planning for this stage of life?
I think this is, like you've alluded to, this comes back to that common question of just property versus shares, right? And the only thing that matters at the end of the day is your time horizon and how likely you are to need that capital in, whether it's 3, 5, 7 years. And that really defines how much risk you can put on the table. And then after that, you're looking at total return. So if you've got a one-bedroom apartment, I'm not a property expert, but just from public, reading and a bit of education out there, apartments are generally considered a little bit on the lower growth side of property in general.
Mm-hmm.
So
definitely,
you may be keen to get into property, and that apartment might be your only avenue into property. But if it's not a high quality investment, the shares might be the better option. Now, every property is different. That's why they're not considered financial investments, and that's why we can't recommend people invest in specific properties. We can only talk about, the cash flow implications and the return implications of how it may fit into someone's goals. But I guess, as a general comment, you'd be really wanting to consider, is this particular apartment a good investment?
Yeah. Yeah, and that's where getting the advice of like a buyer's agent or even just doing your own due diligence. We've got a free course that's put together by a buyer's agent, actually, and a great mortgage broker that's free. So our free Property 101 course for anyone that's buying a house, it's designed for you. In my experience, I think there's probably another reason that someone might buy an apartment in the meantime is if they're renting. So by having their own property, like even if it's an apartment, they're effectively paying their own mortgage versus paying the rent. So maybe they build up some equity in that place. So because a lot of times one-bedroom apartments, as you alluded to, James, in my experience, they don't really go up anywhere near as fast as a standalone house, or even a lot of them don't even go up at all over a 3 to 5 year period. It's more, most people buy them for the income or for the lifestyle benefits of being close to things, whether you're in retirement or a younger person. It's not always, some of them definitely go up in price. We've seen that recently, but it's not always the case, because you can always just, if you're a property developer and you see an apartment building, all of the apartments are going up in price. Well, what do? You just go and build more apartments. And then the existing apartments become less valuable than the brand new ones because the brand new ones are brand new. Yeah. So that's not to say people shouldn't use them. I think it's a great stepping stone, particularly in the major cities where it's maybe more expensive. But it's about understanding, well, what costs am I going to be on the hook for? Even if the house doesn't go up, like worst case scenario, it doesn't go up. The apartment doesn't go up. What can I bake into my assumptions here? Like, am I going to be paying down the mortgage, and that's how I'm going to get ahead in terms of the overall position, paying off the loan? Even if the property price stays the same, I get more equity. Do I save on rent? Is that a good move? If it's a bigger apartment, maybe you could sublease a room out or something like that. I don't know. But I think that in any case, it oftentimes does make sense cash flow wise for people to do that step. But as you say, if they're going to be losing money on the overall pie, maybe a better solution is just to slowly dollar cost average. And I think that, for what it's worth, Rascally Rabbits, I think you've asked the question in the right way, because you've also said that you've mentioned ETFs and dollar cost averaging, which we know dollar cost averaging is a very prudent, sensible way to invest for the long term. Just breaking up your investment into chunks when you get paid or something like this, you can just chip away at it and chuck that into ETFs. And ETFs, as we've said on the show many times before, are a fantastic way to invest for beginner investors. So absolutely, like you're definitely heading in the right direction. It's now just a chance to sit back and do that modeling on that property, maybe assuming that it doesn't go up. And if it does go up, that's just an extra bonus for you and your long-term plans. Hey, James, you did mention there something. I've got another question which falls out of this, but you did mention something about, so advisors don't tell you which properties to buy. But say, for example, Rascally Rabbits became a client of yours. When you think about doing that kind of assessment for them, what are the things that, did it make sense what I was saying before about, maybe there's a different strategy there around, you're paying off the loan and that's what's helping you get ahead. Does that make sense to you?
Yeah, absolutely. So, I mean, there's that common phrase that rent money is dead money, which it's not necessarily the case. You also alluded to an apartment might be in a more desirable location, might be in a convenient place for you to live. You might be wanting to be in the middle of a major city. And that could be true whether you're the one buying the apartment or you could be renting somewhere, in a primary location. Where you want to eventually live might be in the suburbs. It might be, further out. It might be a completely different style of property. But I guess, there's so many personal circumstances it comes to it, and that whole financial planner thing, it depends. So I guess without sitting down and having a really more in-depth chat, I think the broader theme is that, you want to look at total return. You can get some leverage benefits with property that you can't always get with shares, but the leverage really comes when you're actually getting a return. So if you're not getting a return or a very small return, then the leverage might be null and void. The other consideration with property is you've got transactional costs. So the transactional costs associated with ETFs and shares are relatively low for most brokerage, but property is not the same.
Yeah. And then you'll have strata fees, or body corporate, as we call it here in Victoria. You'll have those types of fees that chip away at apartments. Like someone's got to pay for the lift and the entry foyer, the new paint, the window cleaning, all that sort of stuff. So that's a real thing, and you can investigate that before committing to buy a place. So factor that into your cash flow. Another big one that actually Amy talked about quite a bit in our free property course, and she does on the Australian Property Podcast talk about this a bit. A lot of the lifestyle circumstances here are also along the lines of, you might only be able to afford an apartment here. Now, this person has said my partner and I, but if they were single and they're saying, I'm looking to buy an apartment, blah, blah, blah. One of the things that people underestimate is the ability for the household income to rapidly increase in their 20s. So you mentioned a career change before. If you were trying to get a loan during the middle of your career change, the bank would have looked at you and been like, James, I'll give you $100,000, maybe, right? Yeah. But then you go in and you become a fully fledged financial planner, you're earning a better salary, you've got good career prospects, you've met someone. I'm just saying hypothetically, all of a sudden the bank goes, wow, you guys, we'll give you, 600, all of a sudden you can afford a different property, and the timeline to what you can get and the quality of the asset that you can buy drastically changes. So what I would encourage people to think about is also the trajectory of your earnings capacity over the next few years, because that will play a big role in that next house, or even if it's worth waiting till you get that pay rise. One thing in my conversations with mortgage brokers to keep in mind is that bonuses, if you get big bonuses at work, they're not always treated the same way as like a salary. So if you get a $50,000 bonus, they might only factor in half of that, or they might only factor in a bit of it when they're doing your lending assessment. So definitely remember that. It's always better to have that full-time job, even if it's paying slightly less than the bonus one or the casual one. That is what gives the bank more confidence to lend to you. Now, there was a question that came through, James. I don't actually have it in front of me, but there was a question that came through about the First Home Super Saver scheme, and it was a very particular one. So people, if you don't know, you can use this First Home Super Saver scheme to save for a property. And we've done a recent webinar with Gemma on this. But the question, which was, here we go. So the question was originally supposed to be on our Australian property podcast, but I might answer it here because everyone would benefit from this if they're looking to buy a home. I've been listening to your podcast for a while, says Razor the Imp. Excellent job. I don't believe ever hearing the 85% withdrawal rule for the first home super saver scheme for concessional contributions discussed here on other Ross podcasts. Could you please touch on this and how it can be justified to use the first home super saver scheme for someone with a low marginal tax rate, for example, less than 30%? Now, I might just get you to weigh in on that in a sec, but just quickly, the first home super saver scheme is it opens the door for people to add some money to superannuation. There are limits on how much any one individual can put in 1 year, and also over the full course of using the scheme up to $50,000. But what people don't always understand is how money is taxed in super. One of the things that happens when you put money in super and you claim a tax deduction, which you can do, that's called a concessional contribution. That's taxed at 15%. And so this person is saying, well, what happens if my tax rate, James, isn't much more than 15%? Can you just talk generally about the tax effectiveness of using the scheme, or just pros and cons generally of using the first home super saver scheme if you're not on a big salary?
So I guess the first comment would be, the 15% tax rate within super and how it compares with tax rates outside of super. Now, for the lowest marginal tax rate earners up to, I think it's $45,000, 16% tax rate. So when you compare it with super's 15%, there's nil difference there. Essentially, if you're in that tax bracket, claiming a personal tax deduction for any contributions, whether you're using the first home super saver scheme or you just wanted to contribute more money into super, you aren't really receiving much of a benefit. So, and I guess with the first home super saver scheme, the other comment would be, if you're on that marginal tax rate, you've got lower earnings, what's your borrowing capacity? I mean, property in Australia has gone crazy over recent years. I would question what kind of properties would be available when you're not on an income at that level. But look, the grand scheme of things is the higher your marginal tax rate, the more benefit you get from claiming a tax deduction from putting money into super. So for those earning in that higher 47% tax rate, you're getting quite a bit of benefit for utilising the scheme.
Yeah. And for people's benefit, this can be a really good strategy to use, in my opinion, anyway, because it's $50,000 per person, so $100,000 for a couple, limited at $15,000 of contributions a year. But here's the rub, is that when the money goes in, you don't get the superannuation funds return. You get something called the deemed rate. James, I don't know if you want to weigh in on what that is really quickly.
Yeah, so it's a little bit technical, but essentially the way they release the funds, they don't just want to say that you might have had a great year and you got a 20% return. That's not to say that you can withdraw that 20%. So the ATO has a limit. It's called the shortfall interest charge, and it's assessed each quarter as to what that is. And that rate of earnings is what you are eligible to take out when you lodge your application to release the funds. So I think at the moment, off the top of my head, it's around 7%.
Yeah, it is. Yep.
So so you put in your $50,000, you claim your tax deduction for it over a period of years. You're eligible to take out 85% of that because the 15% tax was paid by the super fund on your behalf. But then you're also eligible to take out the shortfall interest charge earnings over the period that you've been utilising the scheme.
That's a really good explanation. Well done.
Thanks. Thank you.
So that's a really good point, is that you're getting that 7%, which for a lot of people, even if you're on a lower tax rate, you might be like 7%. That's pretty good. If the super fund or the ATO is willing to suggest that I could maybe get 7%, that's way better than my term deposit or my savings account. Obviously, that can change through time, so definitely keep that in mind. But there is substantial benefit to that. And now, if you're on a higher income, if you're on 30% tax rates, which, as you say, James, is over $45,000, suggest most people on this, unless they're taking a career break, most people on this show, listening to the show, have tax rates above 30%, marginal tax rates. So all of a sudden you're starting to think, well, I should definitely take a look at this thing because I could potentially claim a tax deduction for contributing to super. Plus, there's this deemed rate, which seems pretty good, and I'm not taxed on that personally. And then I can use that to buy a house. Now, there are a bunch of asterisks and rules and things like that. Remember, the limit is 15 grand a year as it stands today. It could change in time. But overall, I would say the first time super saver scheme has got way better than where it started. It's got more budget friendly, like you can do more with it now. It's a clearer and easier to actually use the strategy because it is a bit clunky. If you're looking for a quick buy on a property, probably not the strategy for you. But go and check out our webinar that we did on the first time super saver scheme because it will cover a few of these things. Now, James, I did promise the audience a few more questions for you directly that I wanted to ask you, given that this is your first time on the show. For people that are wondering, James is a senior advisor with us at Rask Advice, and he works with all different types of clients. And I love jumping in meetings, James, because I learn something every time. But I wanted to end the show with a few more things just about you. Mm-hmm. I might start with the one I was going to ask last, actually, which is you've got a young family. You've got 2 kids now. I wanted to know, for everyone that's listening to the show, how did you prepare financially for starting a family?
So this is the same question with the career break as well. For most people, I would say these kinds of events are coming. So you've got some time to prepare. And for me personally, my lived experience was we knew that we would be, between my wife and I, we'd be taking some time off. We would be on reduced incomes during that time, which we both were for our first child at least. And it was a matter of worst case scenario, if we don't know what our spending is going to be during that time because it's a new experience. You've got a kid, you don't know how much they cost. Some children unfortunately have more needs than others as well, which can play a major factor. So our experience was, if we don't have any income for however long, whether it's 6, 12, 18 months, are we going to be okay? Or if we've only got a limited amount of income, how long are we going to be able to survive? So I think from our perspective, we knew what leave we were entitled to from work. We researched what leave we were entitled to from the government. We already had a decent budget in place, so we kind of understood what our outgoings were, or if we had room to adjust those outgoings. And then you can pretty simply model, okay, this is how much time we want off, and this is how much leave we're entitled to. What's the gap? And then you just go from there.
Actually, this just reminds me, I didn't even think about this. You're currently working on the family finances course.
Yes.
The new course that's coming out on Rask. James covers all of this. I didn't even think about this. This is not expected. So there's a new course coming out on Rask, which is it's for people that are planning a family, have a young family, or are just kind of emerging from that. This is the course for you. So it will have heaps of things, including like a budget and a way to kind of calculate that gap, some of the expenses, some tools around that. So it'll have heaps of information. It'll also loop through to our other courses, like the property course, like things on the first home super saver scheme, all that stuff. So that'll be coming out in the next 2 months. So go and check out the Rask Education website. That's education.rask.com.au, because that'll be coming up soon. That launches after our retirement course, which is the first one, the new one that's coming out in the next month. So retirement first, then family finances. Go and check it out. Totally forgot about that. That's great. My final question for you, my good sir, is a bit of a fun one. I'd never asked you this before. I still don't know the answer to this question, which is, what was or what has been your best investment and why?
So you said that I can't answer family.
If you do answer family, then I'll ask you for another one.
So it's definitely the best investment, family. I think talking externally, not even financial, we've had some great lived experience investing in our home to provide a quality of life update, various things, renovations, just little things around the house. They add up, and you spend, or for us at least, we spend most of our time in our home. So I believe in creating a comfortable environment for that. If we talk about purely financial, from a return basis, the best investment was a little lithium brine miner called AGY, Argosy Minerals. And
yes.
I don't know the return percentage figure off the top of my head, but it's in the multiple baggers.
Okay, so it's gone up multiple times.
Yeah.
So
it's now gone back down, and I no longer own it. But from the period I bought it to the period I sold it was a pretty good time.
okay, so people need to understand that James is a very conservative person with finance. So as a financial planner, he's conservative. So for you to go and buy this speculative little mining stock is very, very surprising to me, mate. But I actually really appreciate your first answer. Obviously the family one, but the first financy one, which is creating an environment for you and your family. I think that's such a really interesting. I've asked that question like 100 times at least. No one has ever said anything like that. And not only does the kind of improve your own house, increase the value of your house, which you could later do debt recycling or sell and then upgrade or do whatever you want with, but it also just is that kind of the merging of the lifestyle asset and the real asset, the financial asset. And it's something that you can enjoy while you do it. And having been to your place recently, I know how much pride you take in that. So that's a really good answer. And I've got to admit, we speak to a lot of people just in the community or clients who, they might be great investors on paper with their ETFs and their shares, but at the end of the day, a lot of them, it's their properties that make them the most money. So many people listening to this can definitely relate. Well, James, first time on the show, first time on the Australian Finance Podcast. I know you're probably itching to go and listen to the Australian Investors Podcast. Maybe you'll make a cameo over there. I hope you do in the next few months. But mate, I really appreciate you taking some time to join me on the show.
No, I appreciate the opportunity, Owen. Thank you.
Thank you. And if you want to get a question on the show for next week with Gemma, she'll be back next week, fresh from her stint in Bali. You can write into us using the podcast player or your description. You'll find a link there to ask a question here on the Australian Finance Podcast. So once again, James, thanks for joining me.
Thanks, Matt. Bye.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on RAS YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.